Y para hablar sobre desafíos y oportunidades de inversión, perspectivas de los fondos de pensiones, nos acompaña el Dr. Simon Coxeter, Growth Market Director of Strategic Research de Mercer, Singapur. Bienvenido, adelante.
Good morning, everyone. I'm very happy to be speaking after Gabriella's excellent presentation, as I'll be touching on some of the same issues, actually, in my presentation. Unfortunately, today, I'm going to be giving you a lot of bad news. But I will try to give you some good news, just enough good news so that you can still enjoy your lunch later. Now, before we dive into some of the investment-related issues, I want to just step back a little bit and take a look at the overall condition of pension funds around the world, because it's important to remember that even if we solve some of the investment issues, we've still got a lot of other issues to deal with when it comes to pension funds. So let's begin with a very simple question. Are we in good shape when it comes to pension funds? Well, to answer that, I'll refer to some of the work of my colleagues in evaluating pension funds around the world. And they look at three key dimensions of adequacy, sustainability, and integrity. And I won't go into the calculation methodology for this index, but it covers a lot of key factors. And I can tell you simply that if you are not living in a country with a system that is rated by this index as being robust, sustainable, and with high integrity, then there are pretty good reasons to be worried about retirement. Very unfortunately, very few people are living in one of those lucky countries, like Denmark and the Netherlands. And literally billions of people are living with systems that are either weak or unsustainable or both. And you'll see from the map here that this is a problem across developed and emerging markets. But we won't dwell on that bad news for too long, and I'm happy to say that that set of tough questions is not my area of expertise, and it's really my colleagues' problem to fix in future, and I wish them a lot of good luck. Sadly, the investment side of the pension fund equation also has its challenges. But the good news is that we can actually do something about it and maybe even seize some opportunities as well. Now, they say that the golden rule in a presentation is to offer no more than 3 key messages, but we're in very challenging times. So I'm going to break that golden rule and ask you to remember 7 key messages. So bear with me. Firstly, in this difficult environment, it's very important to stress test your portfolio and your asset allocation, your positioning, and prepare your portfolio for volatility. And I'll tell you why later. Secondly, I'm going to encourage you to increase exposure to skill-biased strategies, such as those found in the alternative space. And partly so that you can increase exposure to illiquid segments of the alternative space, I'm going to urge you to really evaluate your illiquidity budget and utilize that illiquidity budget. And for a number of reasons that I'll go into later, we want you to really reevaluate also your fixed income exposures. And unfortunately, some of these recommendations will cost you more money in terms of fees. Free up risk budget by considering low fee exposures such as passive and also systematic strategies that are increasingly on offer in the market. Home bias is common across portfolios around the world, despite the many problems with that. And we're going to ask you to reduce that home bias, or at least consider that. And finally, we're going to focus on sustainability, which is really a really key issue for us at Mercer, and we think for many investors around the world as well, and we'll go into why later. But first, let's have some context. We've benefited from exceptional period of equity returns over the last decade, and a global all-country index allocation would have given you double-digit returns, and that's even without the benefit of active management and the additional returns there. And that has been fantastic for pension funds because equities constitute a significant portion of many pension funds and often the majority of the risk budget as well. Sadly, that wonderful experience is unlikely to be replicated over the next 10 years. And these are just Mercer's long-term return assumptions, but really most estimates that I've seen out there in the market show a similar relative picture. And on top of that, I think there's a broader recognition that we're due for a significant equity market correction over the coming years as well. So these are issues that pension funds need to think about. Now, on the bond side, lending standards have been declining and outstanding debt has been increasing, obviously. Because basically the wall of money from QE programs has given borrowers the luxury of negotiating better terms, for example, by removing restrictions on interest coverage ratios and leverage as well. And this is the chart on the left here shows this in the US leveraged loan market. Covenant-light loans, basically looser terms on those loans. And this is not an insignificant market. This is US dollar, over $1 trillion US dollars in size. So we're not talking about an insignificant area. We see similar trends in Europe as well in terms of lax lending standards. And we think that this has swept some bad news under the carpet because some of these borrowers would have undergone technical defaults by now if it had not been for looser covenants on those loans. And what this might mean is that investors, the average amount that they recover from defaulted loans could be significantly lower than we saw in 2008 due to those lower protections. And this could really exacerbate any significantly negative credit event, we think. The chart on the right here just shows default rates for non-investment grade, speculative grade debt globally. The dotted gray line's a simple average. Default rates have been quite low over recent years, but it's certainly not hard to imagine that increasing substantially given the backdrop. And by the way, even in the more credit-worthy investment-grade credit sector, leverage levels have increased so much that now a large portion of that debt sits at BBB, just on the edge of high yield. So if we get a significant deterioration in credit from here, we'll get automatic price hits across that space. And many investors, when it's reclassified to high yield, will not be allowed to hold that debt as well. And you can imagine what the implications are of that. It's worth also noting that the end of quantitative easing could trigger wider credit spreads because non-government bonds have formed a material part of the asset purchase program, particularly in Europe. So two key actions relate to this. Most importantly, we need to stress test the current asset allocation to see what the portfolio would look like if bonds play a less effective role in downside protection, particularly alongside an equity market correction scenario. Secondly, we need to reevaluate the composition of our fixed income portfolio. We are quite cautious on high yield and investment grade credit. And with the withdrawal of central bank liquidity, there is a risk that previously quite liquid credit markets could become much less liquid in very short order. And here I just give you some background on what European pension funds are doing. More broadly, if this late cycle theme that we talk about plays out, as we might imagine, we expect to see pretty good opportunities in distressed debt in future. Now, why do I mention that now? Well, distressed debt tends to be on the edge of most clients' radars, and it can take some time to get familiar with that space. So you really need to start the due diligence process early so that you're ready to move when the time is right. We strongly prefer fixed income managers that can rotate across credit sectors, such as multi-asset credit managers, and also absolute return fixed income. And we see more and more interest in those managers in Europe and also Asia as well. And with banks much less willing to extend loans in certain areas, there are certainly opportunities for institutional investors to step in as providers of liquidity. And we like secured finance and also private debt as potential beneficiaries of that trend. And think that investors are quite well compensated for complexity and illiquidity risks as well in that space. Now, stress testing the portfolio, it very quickly becomes apparent that we need to do much more to diversify away from equities and bonds. And to meet return objectives, we can't rely so heavily on traditional beta returns also, which means that alpha and alternative risk premia have a role to play as a larger portion of the overall return stream for a particular fund. Now, although I refer to skill-biased strategies here, it isn't just about skill, actually, but also about diversifying payoffs from premia like illiquidity, complexity, and deal risk, for example. And alternatives can actually help to solve both the diversification problem, but also the return problem as well. And on the left, we see a typical traditional portfolio, lots of beta in there. It may look quite diversified by capital allocation, but the reality is that equities is dominating the risk budget. So there's much less true diversification than we'd like. And if we add alternatives, a diversified pot of alternatives, you can see it creates a much more diversified risk profile, which is much less dependent on traditional betas. And that's very useful when equities and bonds are unlikely to perform as they have done over the last 10 years. So alternatives can be a winning proposition within a portfolio. But despite this, the average level of alternatives exposure varies quite significantly across markets. And I don't show it on this chart, but it also varies significantly by pension fund size. So larger pension funds with bigger governance budgets tend to have larger alternatives exposure around the world. And the good news is, though, that we have seen generally an increase in alternatives exposure over the last 5 years. And it's worth noting that regulatory and policy changes are facilitating greater activity in that space for many pension funds. Now, if we look a little bit deeper at alternatives exposure, where we have reliable data in Europe, we can see that real assets are the most common alternatives exposure. Typically, property constitutes a large portion of that. Although we do also see significant hedge fund exposures as well nowadays, and we see that increasing over the last 5 years. We also see, quite interestingly, that the largest average exposure is to third-party multi-asset strategies. And I'll talk a little bit more about that in later slides. But first, I'd like to highlight a potential opportunity driven really by central banks stepping back as liquidity providers. And we're talking about trillions of dollars cumulatively to be withdrawn from the system over the coming years. Specifically, we think this could create opportunities for private markets to become much bigger market participants, particularly with banks playing a much diminished role as providers of liquidity and credit post the GFC. And it's worth noting that private market assets were excluded from quantitative easing buying programs, so shouldn't be so directly impacted as that winds down over the coming years. But still, to get comfortable with a sizable private markets allocation, we really need to be confident about our illiquidity budget, and that requires some real analysis and focus. And then at that point, we can decide, okay, now we can really utilize this with confidence going forward. And it's very important, we think, also to be very diversified across manager, the capital structure, and also vintage in that space as well. And this chart just shows the increasing interest we've seen in these strategies over recent times. And certainly, we expect that to continue. Even Q1 this year, we've seen increased interest in this space. Okay, now I want to touch very briefly on third-party multi-asset strategies, because they've been used in various different ways by pension funds and other types of clients to address various different challenges. Firstly, they are fantastic all-in-one solutions for smaller clients that don't have the governance budget to manage a diversified portfolio of assets. And of course, within defined contribution schemes, these strategies can play a really crucial role to the end client in giving them an all-in-one solution. And as I'll touch on later, these strategies can also help to increase the agility and dynamism of what otherwise might be quite a static portfolio. And again, this is really helpful in preparing for volatility. And again, something I'll pick up on later, these strategies can be really helpful in diversifying the asset allocation decision itself, which is really important. Although many clients have the governance structure and expertise to invest in equities and bonds, we see them increasingly use multi-asset strategies to introduce new exposures into their portfolio. And it's a really great way to dip your toe in the water with a new set of exposures and have a third-party manager basically manage that dynamically. And over time, you can then learn about that new area as well. And finally, next to liquidity buffers, we do see some pension funds use multi-asset strategies as liquidity buffers. And the advantage being they can keep the rest of their portfolio stable over time, but they're deploying that liquidity buffer across a diversified range of risk premia in the interim. And lastly, clients enter into strategic relationships with multi-asset managers. And this really, frankly, comes into our territory as consultants, because managers are actually advising clients on many different areas in these relationships and are willing to transfer across a lot of intellectual capital in the process. We also see multi-asset strategies used as an alternative benchmark within a pension fund as a way of evaluating the manager's own performance. Quite useful in some cases. But I want to elaborate on the point about decision-making diversification, because it really fascinates me to look at the structure of our industry and the way resources are allocated and decisions are made. Starting with security selection, so many people involved on the buy side, on the sell side, portfolio managers, analysts, and security selection, lots of different approaches to security selection within any given portfolio. So individual decisions very nicely diversified in a typical pension fund. Another segment of the so-called industry value chain, manager selection and implementation, again, quite a lot of resources put there and quite a lot of diversification, actually, in the decision-making side on that front. But when we look to the most important part of the portfolio, the asset allocation decision, and pretty much everyone agrees that drives the majority of risk and return variability over time, surely that must be heavily diversified and there must be lots of resources going into that area. Well, actually, no. Often just a handful of people are making the asset allocation decision for a particular hedge fund, a pension fund. And success or failure often rests on one set of asset allocation decisions. So there really is no diversification in decision-making on that front. And this is a genuine vulnerability. But let's have some historical context. Back at the beginning of the last century, US pension funds invested exclusively in local bonds and insurance contracts, and it really wasn't until the middle of the last century when they expanded out into equities via traditional balanced portfolios. And over the last 60 years or so, we've had various different approaches to asset allocation and risk management. Mean variance optimization, all the way through to risk parity. And the reality is that none of these are perfect. And they all have their strengths and weaknesses. So one of the value propositions of multi-asset strategies is that they can adopt different approaches to asset allocation, and they can sit alongside an existing asset allocation framework to diversify that core component of decision-making. And as I mentioned earlier, multi-asset strategies can also introduce dynamism into a portfolio, and some clients have fairly static portfolios with very little in the way of tactical asset allocation. And this example is based loosely on a particular client that had government bonds, a little bit of credit, and some equities, but they didn't have the governance structure or expertise to move beyond that. And the solution in this case was to introduce a multi-asset strategy, which really provided a double win because it introduced exposures that the client wasn't familiar with or comfortable with managing, but it also introduced dynamism into the portfolio. Sorry. Thank you. Sorry about that. So it was a double win, and multi-asset strategies are increasingly used to introduce both new exposures and also dynamism into portfolios in a very, very easy one-step way. Okay, so I need to give you some more bad news, I'm sorry, because investing in alternatives and some of the specialized types of fixed income strategy that I mentioned will probably cost you more money in terms of fees. And the reality is that some clients have regulatory or other limits on the fee budget that they're allowed. So how can they afford these higher fees? Well, this is where we need to get more sophisticated about using passive and low-fee systematic strategies in our portfolios. And the range and sophistication of these strategies has really increased a lot over the last 10 years. And many of you will have heard of smart beta products, for example. It's important to note that some of those are not so smart. But really, this product innovation has been driven by a strong desire for low fees. And Mercer, for example, has been very vocal on fees over the last few years. And I got to say, since we've been vocal, I get far fewer invites from asset managers to go to lunch, which is one of the perks that I've lost, I guess, as a consequence. But seriously, though, we need to be very selective about using passive and really focus on areas of the market that are more efficient, where active management is less likely to pay off. So, for example, US large cap equities. That's kind of a no-brainer. Looking at pension funds in Europe, we see how the smaller governance-constrained pension funds have moved significantly into passive strategies over recent years. And even some of the larger pension funds have utilized these strategies quite extensively, lowering their overall fee load as a consequence. But alongside the cheap passive strategies, there are also cheap factor-oriented strategies, which can also play a valuable role, actually, in replacing some of the long-only, higher-fee active exposures. And there are also quite a lot of low-fee alternative risk premia strategies as well, which can replace some of the alternatives exposure in diversifying the portfolio in a more cost-efficient way. But I know that passive is a dirty word in some circles, so I want to assure you that we believe in active management. But we also believe that effective implementation of active management requires clients to withstand periods of underperformance and be mindful of the behavioral biases that are so common in hiring and firing decisions. And this is just one of various academic studies that illustrates how much value can be destroyed in this area, with average relative returns after hiring much lower than returns before hiring. So clients were clearly influenced by historical returns, but those strong returns did not persist over time. And sadly, it's the exact opposite for firing decisions, with underperformance before firing and outperformance after being fired. And our own proprietary analysis and engagement with clients really suggests that this issue can really detract from the efficacy of active management. And to be honest, this topic alone requires its own presentation. It's such an important one. But I'll add to this point with one more slide, because we found that it's pretty important to be realistic in our performance expectations when we enter into a relationship with an asset manager, because this helps us both figure out a fair level of fees, but it also reduces the chance of disappointment and therefore the client making a bad decision on firing a particular manager. And I show a chart here. We can see the average formal outperformance targets, the objectives, across a range of strategy universes. And this looks pretty good, right? Who wouldn't take this? It looks fantastic. But these are typically just dreams for clients, because the average reality is not so good. And although at Mercer we can beat these averages with a solid manager selection framework, we're still not going to achieve dream levels of outperformance across all categories. So it's something to bear in mind when we enter into and do seriously an active management framework. Moving on to another important topic, the home market bias. Now, there may be regulatory, political, or even practical challenges in reducing the home bias, but in some cases, unconstructive behavioral biases are the key culprit driving that home market allocation. Let's acknowledge, though, that a home market domestic bias often makes sense in the fixed income portfolio, given the currency issue and the cost of hedging. But a home market bias for equities is much harder to justify from a pure investment perspective. And here I show the average percentage of pensions equity portfolios in domestic equities across a range of countries. And Denmark had by far the lowest local market exposure, but most other countries have over 30% allocated to their own equity market. But a large allocation doesn't mean that there is a bias necessarily if that market represents a large portion of the global opportunity set. So to figure out the home bias, I've compared these domestic exposures to each country's percentage within a market cap weighted construct. And you can see Even Denmark has a home bias once we make that adjustment. And this is a fascinating topic, given the various reasons for these biases across different markets. In Malaysia, for example, one single pension fund represents well over 10% of the local equity market. So you can imagine the practical challenges of reducing that home market bias for that particular client are pretty significant. There are big implications. Now, the good news is that with only a few exceptions around the world, we've seen reductions in home equity market bias across really many markets, as shown by the gray numbers here. But as the sizable blue columns show, which ideally should be close to zero, there's still a long, long way to go across much of the world on this front. But then I hear you ask, well, why do we really care? Why is it important? Well, there are a lot of reasons why the home market bias is a bad thing, but what I've found is with clients, talking about the theory kind of gets boring after a while. So I prefer to show you what can happen with an individual market allocation. I think it's more intuitive. So this chart shows periods of weak US dollar and local currency equity performance across various markets historically. And at the bottom, for example, we have New Zealand in the late 80s and early 90s, a significant crash of 70% roughly, and incredibly painful if half of your equity portfolio is in the local equity market. And this isn't actually the bad news though. Because oftentimes negative performance bounces back really strongly, as it did in the GFC and after the GFC in 2009. So clients don't necessarily lock that loss in. So let's now see how many months it took for New Zealand to recover to the original value before the crash. Well, we don't have total return data, unfortunately, going back that far for that market, but excluding dividends, New Zealand still hasn't recovered to the 87 peak over 30 years ago. And looking at other markets, and all of these other markets are based on total returns, we can see other examples of painful drawdowns and some long periods to recovery as well. And much of this pain could have been avoided with a globally diversified equity portfolio. So it's really imperative to stress test your portfolio to see what it would look like with a significant local market drawdown. We also think that geographic diversification could be more important going forward. It's true that economies and markets have become more intertwined with globalization, resulting in higher correlations between markets and, frankly, making diversification look less important on a historical basis. But looking to the future, we think in a multipolar world, with China rising and becoming an additional strong force economically and market-wise, and with various other forces that could slow globalization, we could see more dispersion in returns across markets. And finally, sustainability is a huge topic, and at Mercer we believe there are opportunities to really make money as well as big risks to avoid in this area. And next week, for example, we'll be coming up with a large study on climate change, leveraging a lot of financial modeling. And our modeling suggests that there could be significant additional returns from sustainable investments in scenarios where the world takes significant action to mitigate climate change. And over the last few years, we've seen more and more interest in responsible investment or ESG-related strategies, and still quite small in dollar terms, but certainly growing really fast. But from a pension fund perspective, the focus on responsible investment is quite mixed, to be honest. Even in Europe, where this topic is generally much more popular than in Asia and other regions, many pension funds still have not really addressed climate change with much focus at this point. And we really think this is an important area that most clients need to pay more attention to. So we've covered a lot of issues in this session, but if you take action on at least a few of these points raised that are most valid for your portfolios, we think that will increase your chance of a better outcome for your portfolio over the longer term. And I'd certainly be happy to come back in a few years' time so that you can blame me if that turns out to be wrong. Thank you very much.